So I've been talking a lot about investing lately, and I did that rant video recently that speak them about people using it as a get-rich-quick scheme or thinking it is and failing miserably with the whole dog coin thing and all this nonsense. But people have asked me, okay, Geekdom, how do I start? Like, what do I do? Where do I actually start? How do I actually start to build wealth? Okay? And I want to talk about, sort of the principles of building wealth as far as things you have to understand before you begin. Okay? And then I'll tell you how to begin. All right? Because a lot of y'all are young, and the younger you are, the better. Okay? The younger you are, the better because you have more time. The older folks don't have enough time. Or they have enough time, but they don't have as much time. And time is on your side, but you can't wait because you have to take advantage of your youth now. You know what I mean? So here's the first thing I want to discuss. First of all, investing and building wealth is not a get-rich-quick scheme. You're going to have a lot of people throw bullshit at you. You're going to see a lot of YouTube ads talking about, do this and you'll get here. And, what if I told you that if you have $1,000, you can turn into $1 million? No, that's BS. Don't fall for any of that BS, okay? And there's lots of folks out there who want to take advantage of you and take advantage of your money. There's also brokers out there and bookies who, while all of them aren't bad people, some of them are genuinely good at what they do. They oftentimes charge commissions or they work for a company who's trying to sell you something, whether it be that company's mutual funds or whatever the case is. So you have to be careful with all this stuff. Be very weary of it. We're very cognizant of it. You don't need anybody else to help you, although there are people out there who will help you. And I'm not saying not to use a financial advisor. That's not what I'm saying. But make sure that if you do go with a financial advisor, that the person has your best interest and is not trying to sell you something. You got to really pay attention to if they're trying to be a good teacher or if they're trying to just tell you what to do with your money. Okay? Because one thing I advocate is to do your own research. Do your own research, okay? First of all, when it comes to investing, it depends on how much money you actually have in your current situation. If you are working and you have kids and you're having problems paying the bills, you probably don't have that much extra money to spend to invest. However, if you're young and single, and when I say single, I don't mean without a girlfriend, I mean without a wife and kid. You don't have the responsibility of a family to worry about. And when I say wife, it also goes the other way, husband. This is a genderless video. It could be for any gender, any ethnicity, anybody, right? If you are single or whatever and not married without kids, then you have an advantage because it gives you more free money. You have more income coming in. Second of all, just because you don't make a lot of money now does not mean you can't invest. It all depends on budget. It all depends on how you budget your money. If you make X amount of dollars an hour, but you go out and you buy video games every single weekend or blow the money on gacha games, if you blow $200 on a gacha game every week, yeah, that needs to stop. That really needs to stop. Really. It is a gambling addiction to play those gacha games. It sickens me that people actually have the audacity to say investing is gambling, but they play Dokkan Battle, which is actually a waste of money when you really think about it. It's mind-blowing, but that's a different rant for another day. So you have to also just take into account that, the important thing is to be patient. You need to be patient, okay? You're not going to get rich overnight. I'm telling you that. I've mentioned that a million times before. Can you build wealth? Yes. Can you retire in your 40s? Yes. This is all possible. Obviously, there's different factors, where you live, what kind of life you want to live. There's a lot of different... I won't be able to cover everything in one video. I just won't. I just can't. There's way too many variables. And every person out there has a different situation. All of you are different. You're culturally different. You may have religious differences. You may have a tithe you want to pay to God. Some of you don't care about that. Some of you do. Some of you want to live in LA, which is way more expensive than living in North Carolina. There's all kinds of different things. But the principles here is that it's going to take time. So remember that. And remember that the thing is that as long as the United States has not become a third world country, as long as things don't get terrible, putting your money in the right places, in safe places, will pretty much guarantee you a profit. Now, I can't guarantee anything. Nobody can, because you never know. But if you look at historically how the New York Stock Exchange and the stock market has performed for the past 100 years, it's been consistent growth. People who have invested young and invested wisely have been able to reap their benefits later in life, whether it be when they retire at 59 and a half or whether it be before they retire. What you have to understand is that investing is a way to beat inflation. Investing is a way to, when you get older, when you get to your 50s and 60s, you don't have to live this life where you're still working, maybe even for less money, because people don't hire old people like that except for certain jobs like security and things like that. Yes, believe it or not, old people do security jobs. I know because my dad was one of them. Or janitorial work and things like that. You might not be able to get a six-figure income when you're old. So the idea is you want to have enough money so that when you're older, you don't have to break your back and you can enjoy the last few years of your life. However, if you invest young enough and strong enough, you can retire in your 40s and in some cases even in your 30s, even though that is very, very rare and requires a lot of discipline and a lot of work and maybe a little bit of luck too. But if you can at least retire in your 40s or 50s, that's good enough, if you ask me, because then for your 60s, 70s, and 80s, you can travel the world, you can enjoy being with family and friends and see your grandkids grow up or whatever your plans are. That's what you have to remember. This is not about getting rich quick. If you're getting in this to get rich tomorrow, you are going to fail. You have the wrong idea. You understand that? You have the absolute wrong idea. Get that out of your head now. Investing is about making sure that when you retire, you don't have a pension. And, well, you might have a pension. Everybody's different. But a lot of times your Social Security and your pension are not going to cover all your expenses. If you have health problems, if you want to live a certain kind of lifestyle, you're not going to be able to do it with Social Security. You're just not. You're going to be stuck. And you don't want to live in a home. You want to live a healthy, productive retirement. You want to relax, right? Am I wrong on that? That's what this is about. But it's also about building wealth so that maybe you can retire young. And there are many ways to do this. Many ways to do this, but it's going to take time and patience and consistency. So please be aware of this before you get in this game, because if you are getting in this game and the minute that your stock happens to go down, because things always go up and down, but the market always trends upward. Remember that. But the minute there's a crash like what happened last year and you panic sell, you just proven you're not hard enough to handle this game. You have to be patient. I am one who is very pro buy and hold. I've only sold one stock in my life and I regret selling it. I sold a little bit of Tesla last year and I bought it back at a higher price. So I ultimately lost money. However, I wound up making all that money back because Tesla blew up. So I wound up making that money back by buying more stocks. I didn't think it would. I was wrong. Whatever. I wound up making more at the end of the day anyway, so it doesn't matter. Tons. I made thousands of Tesla on Tesla. And I'm not giving you I'm not a financial advisor. I'm just telling you what worked for me. So, the idea is long term. The idea is you put a little bit of money in, little bit of money in, little bit of money in, little bit of money in when you can. You know what I mean? Not every single week, but if you want to put money in every couple weeks or every month, that's good. It all depends on where you go, how you do it. So, how do I invest? Okay, a couple things you want to do. If you're over the age of 18, you want to look into a brokerage firm. Now, again, I want to reiterate this. I am not a financial planner. Everyone's going to take something different. I'm going to tell you what works for me. So there's a few out there. There's a few online ones you can go to. Franklin Templeton is one of them. I used them when I first started. I don't use them that much anymore, but I have money with them still because they have really good mutual funds. There's also Fidelity, Vanguard, M1, Robinhood. There's so many different ones out there. So what I recommend you do is I don't want you to look at individual stocks when you first start out. Do not look at individual stocks. Don't think about buying Apple or Microsoft or Tesla or Amazon. But geekdom, aren't those good stocks? Yeah, they are. They historically perform well because they're good companies. They're strong companies, but that's not what I want you to do. What I want you to do is try to focus on getting a mutual fund or an ETF fund, an exchange trade fund. Now, what is a mutual fund and an ETF? I'll explain that to you. An ETF fund is an exchange trade fund. It's a fund to where it follows a certain group of stocks, or a certain group of stocks on the New York Stock Exchange. For example, there's ETFs on tech, there's ETFs on health, there's ETFs on construction. So it's a group of stocks, and you're basically buying into all of them. So you own a little bit of a piece of all of them. And when you buy an ETF, when you actually go to the page where you see the ETF, it tells you what's on there, top 10. It'll say Apple, Tesla, Google. Actually, for Google, it'll say Alphabet, but that's Google pretty much. Samsung, whatever. Samsung's a Korean stock, but that's a bad example. But, it'll have a whole group of different funds, right? So you know what you're buying. So you're buying a little piece of all those companies. Instead of actually buying individual stocks, which you can do later when you have more experience, when you're getting your feet wet, you'll want to just focus on groups of stocks, bunches of stocks. Why? Why am I advocating this? Because when you focus on groups of stocks, right? If one of the companies does bad, chances are another one will do good, and it will elevate the entire amount of money you put in. So let's say you put in $1,000 to an exchange trade fund, let's just say, right? And Amazon has a bad year, but Apple has a good year, you're not going to lose money on that. Whereas if you just put it into Apple or Amazon, you would lose money. See what I'm saying? Because you never know. So it's safer to put it into an ETF. Another thing you could do is find a good mutual fund. Dave Ramsey talks about how you want to get a mutual fund that outperforms the S&P 500. And yes, there are some out there that do. There are some out there that either perform as good as the S&P or higher. Now, you're probably wondering, what the fuck is the S&P 500? That is the top 500 companies on the New York Stock Exchange. You can get an ETF that follows the S&P, and that's a very safe thing to do because the top 500 companies are going to make money more often than not. And if they make money, you make money. It's that simple. It's not complicated. This is not rocket science. This is what you do to start out. This is for beginners, okay? Obviously, later on, we can talk about more advanced methods and more kind of different kinds of trading. That's later. I want to get focused on the basics, okay? So, a good mutual fund or an ETF fund, which one should I get, Geekdom? Well, again, it's up to you. I would probably get a little bit of both. Not right away. Pick one first and later on pick another one. It's good. Diversification is important. You want to try different things because you want to put your money in different places because then it almost helps you grow more because, again, it follows different parts of the market. But be smart about it. Do your research. Well, that's the main thing. Do your research. If you don't want to do your research, if you don't want to sit there and spend all day going through Google Finance or Yahoo Finance, then I would advise you to get an ETF or a mutual fund because then that way you have so many companies, you don't have to research each individual one. That'll take forever. You at least know that, And when you're buying a mutual fund or an ETF, it actually tells you the history of that fund. Every single brokerage firm I've ever used, if you click it and you can actually see the 1 month, 1 year, 5 year, 10 year, 30 year history of that fund, if it's that old or mutual or ETF. So it tells you kind of if it's gone up, if it's gone down, what the trends are. You can look at that information right there before you buy it. So if you find one that you like, that you think is promising, see how much the minimum is. Some it's 1,000, some it's 3,000. Some have no minimums. ETFs typically have no minimums as long as you can afford one stock. Mutual funds, however, do. And now the reason why mutual funds are different than ETF funds, although they're similar, is that mutual funds are being run by a fund manager. There's more differences, but I'm going to keep it simple for you guys. Now, this fund manager is a guy who works with that mutual fund inside of it to buy and sell stocks for that fund. So he's kind of working for you and every other investor that invests in that fund. However, a lot of times you have to pay a little bit of a charge for that. It's called an expense ratio. Okay? Now, again, every company has different expense ratios and you have to sometimes pay a fee for buying and selling. But in theory, the idea is that if you have a good fund with a good fund manager, you're going to make that money back anyways. Like you won't even see that money gone. Like when you put the money in originally, it might go down a bit, and then in a few days or weeks, it'll just go right back up because you're going to be making that money back. So understand that. That's how it is. There are fees associated with these things. There's load and no load. There's a lot of stuff for me to explain. And all this stuff you can look up yourself. Don't just rely on me. Look it up yourself. Look no load versus load. Just look all this information up. But I recommend when you are first starting out to get a good solid mutual fund, right? And invest in that. That's my recommendation. I prefer, there's two companies I really like, Fidelity and Vanguard. Why do I like them? Because Fidelity and Vanguard have very, very low expense ratios. So if it's like 0.04% or whatever, that means that if you put 1,000 in, it's like $4 a year. And you're going to make that back anyways. You're going to make way more than $4. If it's 0.04, some have 0.01, 0.02, some have 0.00. Fidelity has no expense ratios for a lot of their mutual funds. None. But they don't have the history and the customer service that Vanguard has. So you kind of have to pick, because the good thing about these companies is when you sign up with them, you can actually call them on the phone and ask questions. You can ask them questions, yo. You're not alone. There are customer service reps who are willing to explain things to you, but they're not going to give you stock advice. They legally cannot tell you what to do with your money. They cannot do it. But if you have a question like, does this mean this? Does that mean that? What does this mean? They can answer that for you. Remember that. Use these people as tools, because it's a toll-free number, yo. I can call Vanguard right now and say, okay, can you explain to me the difference between load and no load? Can you explain to me this? And they will do it for you on the phone. Most of them will. And what I recommend you do is look into getting what's called a Roth IRA. If you're making less than $200,000 a year, if you're making more than that, boy, we got to talk, because we can do a lot more. Obviously, the more money you have, the more you can do with, right? If you're making over $200,000 a year, that's when you look into stuff like more risky investments, maybe even crypto. If you really want to go down that road, when you're making that kind of money, you know what I'm saying. But I'm gonna guess most of you don't make that, and someday you probably will. And if you do, then I'll probably do like an intermediate or an advanced course on this at some point, maybe, to help people out and kind of say, okay, you got more money now. Let's really get aggressive now and really get you some good stuff. But I would recommend being, everyone's different. Do you want to be risky? Do you want to be safe? Everyone's different, okay? But anyways, Vanguard I really like. I really like Fidelity. Again, this is just what I like. Everyone's different. There's hundreds of companies out there. Find one that you like. And at Vanguard, there are tons of mutual funds that have performed incredibly. There are funds on Vanguard that if you invested $10,000 in 2010, which is 11 years ago, by now that $10,000, if you don't add a single penny more, listen to me, if you don't add a penny more and just let it grow in there, that fund is worth 60 grand. There are some like that, yo, because it's all about compound interest. The idea with investing is you put money in and it grows interest and it grows value. And then that interest and value becomes part of the principal, and then that grows and it compounds and compounds and compounds. So you put $2,000 in, let's just say, and then you grow to 2,100. Your interest gives you 2,100, right? Let's just say, I'm using easy numbers. Then that 2,100 grows from that base. It gets bigger and stacks. The money stacks and stacks and stacks and stacks and stacks. So by the time that you're like in your 30s or 40s, you might have $500,000 in there, yo. If you keep putting more money in yourself and letting it grow, you're putting money in and the stock market's putting money in for you. So it just grows and grows and grows, right? And then it becomes easier the more money you have. I mean, if you've got $1 million in there and you're gaining just 4%, that means you're making 40 grand a year on nothing. You're not even working for that 40 grand. You're letting the money work for you. Think about that, yo. Can you do that tomorrow? No, but over time, you sure as hell can. You can make $1 million in several years. Not in 1 year, unless you are blessed to make that much money. And again, if you are, we're looking at more aggressive investments here. But if you're working a regular job, over time, it builds up. It really does. It adds up. Do the math. You know what I mean? It's just, you got to just be patient. It's all about being patient. And even if you can't get to $1 million, $500,000's great. $250,000's great. It's money you're going to be using later in life. And I recommend you put it in a Roth IRA, which is a tax-deferred account. What that means is you put money in, and when you take it out, you don't pay taxes on it. But you can't take it out until you're 59 and a half. It's for when you get older. It's IRA stands for Individual Retirement Account. That's what it's for. All this stuff you can look up. Google Roth IRA. Google traditional IRA. All this information. There's YouTube videos. Graham Stephan, Dave Ramsey, Andre Jeek. There's so many people who cover this, yo. So many people. Tons of people who cover this kind of stuff. I'm still not as experienced as they are, but I will be there someday. I'm already on my way. But I'm telling you because I am where you were, or I've been where you've been. And I'm here to help. So this video is going kind of long. I'm trying to keep it simple for y'all. Find a good, try Vanguard. Just try them. If you have $1,000, save up to $1,000. Open up an account with them. Open up a Roth IRA. If you'd like. Again, it's up to you. We're keeping it simple. And maybe there's a few that I can recommend to y'all in future videos. If you really want it, let me know in the comments. I'll do that. But remember to be patient. And remember that when you put money in, don't touch it. Hold it. This is not a savings account. This is not an emergency fund. This is an investment account. You have to leave that money alone. Either add to it or leave it alone. Buy and hold. That's long-term wealth. Day trading, buying and selling stocks every day, that's a whole different thing. That is a different video. Maybe I'll do a video on that if you want. But buying and holding is the best long-term strategy. It's been proven time and time again. Anyways, I hope this helped you. It's a lot of information. I'm trying to keep it simple. I don't really know what to say on these things. I just kind of push the play button and ramble. But all this information, you can look it up yourself to get more information. You know what I mean? To elaborate more with other channels and other articles and things like that on the internet. Or you can just call, or you can even call your bank. And a lot of times they have a financial planner, but you want to be careful with that. Remember, look up your own information and your own education on what you can do and make educated decisions. I'll talk to you soon.